You're watching episode 32 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Additionally, if you have any questions or if anything that I say resonates with you, leave me a comment below. I love interacting with our community and appreciate those of you who take 30 seconds out of your day to engage with me. Thanks for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall, and before we get started, check out our Facebook group and the Tax Smart newsletter. Links to both of those are in the description of this video. Today's topic comes out of the Facebook group, and it's all about whether or not you can rent your home to yourself. The question was kind of centered around the debt portion of Schedule A deduction. So if your mortgage exceeds $750,000, your interest that you can write off on Schedule A gets capped. And the person was asking, can I get around this by renting to myself, therefore classifying the property as a rental and being able to deduct all the property taxes, all the interest without any sort of limitation? And the answer is no. In general, any sort of self-dealing that you do is not going to be respected as a transaction by the IRS, especially if you're ever audited. And if we dig a little bit further here, the real reason why is there's a lack of economic substance. And what does economic substance mean? It means that substance over form says that you have to have some economic substance to substantiate the transaction. We're going to look past the form, past whatever LLC structure you put in place. We're going to look towards the substance of the transaction. Does it have economic substance? To wrap your mind around economic substance in this situation, we can ask one question, and the question is, if you stopped paying rent to yourself, would you evict yourself? And the answer is obviously no. So because of that, because you're not going to have any recourse against yourself for not paying rent, there's no economic substance to the transaction. So you can't go rent a property to yourself just to move all the expenses onto Schedule E and make them deductible. But let's assume that you could. Let's just play this scenario out. Let's just assume that you could. There's another issue with this. Even if you could, there's another issue, and it's found in Section 280 Cap A of the Internal Revenue Code. And that section is not very clear. It's known for not being very clear, but it does make clear that you can't just go and write off personal expenses, or you can't go write off expenses and create rental losses if you're personally using a rental property. So if you're personally using a rental property, you exceed the 14-day threshold or 10% of the total rental days, you're personally using it, then it's not, you're going to be subject to Section 280 Cap A, and you're going to be limited to what you can actually deduct. There's a whole bunch of ordering rules and issues there, but ultimately you can't create a loss. So even if we could rent it to ourselves, we would still be limited. We would still be subject to a set of confusing rules that would ultimately limit our ability to claim the tax deduction that we're really, or claim the tax benefit that we're really looking for there. Thanks for watching today's Tax Smart Daily video. If you have any questions or comments, leave them below, and make sure to check out all of our communities. Follow us online. Links to all those are in the description of this video.